All right, here we are again. It seems like a while since we have filmed, since we've had lecture. So everybody here is taking the test. Hopefully for you folks at home, make sure that you follow my email in regards to the dates, that window of opportunity to take your test. But regardless of whether you've taken it yet or not taken it yet, I want to make sure you don't get behind. So we want to make sure that we keep on going in regards to lectures. We're going to talk about chapter 3 today, which is on adjusting journal entries. And as I've said before, Accounting 1 is very much a building block course, okay? So I have no choice but to presume that chapter 1 and chapter 2 are a solid foundation for you, of which we can build the rest of this class. As I said, I think of all the instructors here at the college, I think I spend more time on chapters 1 and 2 than anybody else because I want to develop that firm foundation, okay? But this isn't the sort of class where you could say, chapter 1 and 2, I don't get it at all, but boy, I'm going to put my efforts towards chapter 3 and beyond. It's not going to really work that way. Not going to really work that way. You've got to have that solid understanding of the first 2 chapters, of debits and credits, of normal account balances, all that sort of fun stuff. And because if you don't, the rest of the class is really, really difficult. So that was why I tried to emphasize that as we went along. Okay? Let's take a look at chapter 3. I know everybody here, I have handed out the PowerPoints. For you folks at home, I have sent or emailed you the PowerPoints. Make sure you're checking your email. Make sure you're keeping it cleaned out so that it can still receive emails and it's not full. But let's take a look at chapter 3, adjusting accounts and preparing financial statements. Okay, a little background here. First of all, in accounting, we can and we do divide time up into periods. Like this is the accounting year, or this is the quarter, or this is the month. This is why when you guys did your income statement and your statement of retain or your statement of equity on your test, you had to say for the month ended or for the year ended or whatever, right? Because that is the accounting period under question. Make sense? There are some companies that just do financial statements annually. There are others that do them quarterly. There are some companies that do monthly financial statements. And there's even one type of company that does financial statements at the end of every day. Do you know what type of company that is? Typically banks. Typically banks will do financial statements at the end of every day. Anybody here work at a bank? No? Okay. But we can and we do divide accounting periods up into chunks, into segments, and we analyze those accordingly. Okay? Another thing I want to discuss again. We use the accrual basis. Now, we have talked about this. I don't know how much I've used the actual term accrual basis, but the accrual basis says that we recognize revenues when they are earned. When are they earned? When the product or service has been provided. And we recognize expenses when they are incurred. With the accrual basis, the basis that we follow, it does not necessarily all hinge on when cash is received or dispersed. Okay? The cash basis of accounting, everything hinges on when cash is received and when cash is paid. If somebody pays you, gives you cash, you recognize revenue under the cash basis, regardless of whether you've provided the product or service. Under the cash basis, you recognize an expense when you disperse money, regardless of when it is incurred. Now, the cash basis is not generally accepted accounting principle. Okay? We use the accrual basis, and that's very key. Okay? And that's why we have principles such as the revenue recognition principle. Okay, I want to go through an example. I kind of like the one that I actually am going to use on the Elmo a little bit more than the one that the PowerPoints give. So I'm going to put this up there. Let's see if you can read that. I'll blow that up a little bit. Whoops, that's a little too much. Okay. Okay. You read that back there, Lauren? Yeah. Okay. All right, let's do this. On December 30th of 2009, we paid $1,200 cash for 6 months of auto insurance coverage for the company automobile. The coverage is for the period of January 1 of 2010 to January 30th of 2010. Okay? Thank you. Very good. Thank you. Please correct me as I go along so the folks at home will know. Let me read that again. On December 30th of 2009, we paid $1,200 cash for 6 months of auto insurance coverage for the company auto. The coverage is for the period of January 1, 2010 to June 30th, 2010. Right? Now, this is like real life. When you guys pay your auto insurance coverage, you have to usually pay it before the actual coverage begins, right? Because otherwise you just wait till the end of the month and go, I didn't get in a wreck, so I'm not going to pay it. No. You have to prepay your auto insurance coverage. So your auto insurance coverage will follow this sort of a relationship. Okay, let's go back to that. Now what I want to do here is I want to draw a little timeline. Let's see if I can divide this up. Let's say this is December, this is January, this is February, this is March, this is April, this is May, and this is June, okay? All right? Now, let me do that actually twice. This is December, this is January, February, March, April, May, and June. Okay. Now, if we were using the cash basis, now we can't and we don't, but if we were using the cash basis of accounting, then we would recognize $1,200 of expense right there. Okay? We would recognize $1,200 of expense all in December. Okay? Because that's when the cash went out, by golly. So we would record the entire $1,200 of expense in December. Okay? Now, what would be a more what would be a more reasonable way to recognize this expense? Split them between the months. Okay? And that's what we're going to end up doing on the accrual basis. Doesn't it make sense if you're paying $1,200 for 6 months of auto insurance coverage, what are you basically spending per month? $200. Wouldn't it make more sense if somehow $200 worth of expense were recognized in each one of those periods? Okay? Because think about it. Think about the cash basis for a second. Think about if we did it this way. Well, you would look at your December monthly financial statements and you would say, whoa, man, our bottom line is really not good. Our net income is really low. Well, and that might be the case under the cash basis because you had that big expense. And then you might go to January and say, oh, good, our net income is back. Okay? Because under the cash basis, you didn't spend the money there. Financial statements would be kind of hard to follow as a reader. Remember, what's the main objective of accounting? To prepare financial statements to help readers make good decisions in their business, right? Yeah. If you use the cash basis of accounting, it's so up and down. It's also, and we'll talk about this, it's easy to distort reality. Okay? So, a much more reasonable way to do it is to do it like this. To use the accrual basis, where actually no money, there's no expense I should say. There's no expense that gets recognized in December in this situation. Rather, $200 gets expensed each of those 6 months. Yeah, Brian.
So then, wouldn't there be? So if you pay $1,200 right off the bat, and then you, on your little accounting thing here, you split it into the $200 each month, how would you be able to keep track of that and not overspend how much money you have in your account? Because you're only recognizing $200 each month going out when you had $1,200 come out before that. Where would you recognize
These are great questions, and this is a good segue into what we're going to do. So hang on there, and I'm going to show you that. I'm going to show you that here in a second. Do remember, though, looking back at this, and I'm glad you said this, Brian, in both situations, we give them a $1,200 cash check on December 30th, okay? This is not, we have not switched in this scenario to a system where we pay them $200 each month. We have not switched to a monthly payment plan. The cash outlay under both of these scenarios is December 30th, 2009, we pay $1,200 cash. This is simply the way we recognize the expense. The way we recognize the expense. Both situations, we pay $1,200. Cash basis, you recognize the entire expense here, whereas under the accrual, we recognize $200 each of those 6 months. Brian, another question.
So then, you would recognize the $1,200 going out right off the bat.
Yes.
But then you would recognize that $200, like whatever utility bill or insurance each month, like after that.
Right.
Okay.
Here's how I'm going to show you how to do it right now. Okay. And the questions you ask are good questions. Okay. This is a good indication that you are thinking through this thing. Okay. All right. Let me see if I can. I'm not sure I'll be able to keep that on there. But I want to show you what the journal entries are going to look like here. Okay? So, on December 30th of 2009, the journal entry is going to be a debit. Well, let's do the credit first. We're not going to list it first, but we're just going to write it down first. The credit will be to cash for $1,200, okay? Because cash is being decreased. Cash is a normal debit balance account. The question is what is debited? Yes, very good. Not insurance expense, but rather prepaid insurance, which is an asset, isn't it? Okay? So right now what we have at December 30th of 2009 is we have an asset of $1,200. Okay? Now, let me see if I can dig out a better pen here. I'm not sure I have another one. Okay, I'll keep using this one. Okay. Okay, so that's the journal entry. Now we start business at the end of January. At the end of January, how much of that insurance has been, quote, used up? $200 worth. Think of it this way. It's like, does anybody ever give you like a Best Buy gift card for the holiday, for your birthday? It's kind of preloaded with dollars, right? Let's say, Brett, that somebody was kind enough to give you a Best Buy gift card that had $1,200 prepaid on it. That'd be pretty sweet, wouldn't it? Well, let's say during January you went and bought $200 worth of Jonas Brothers CDs, okay? Because I know you're a big fan, okay? Well, at the end of January, your card is now worth $200 less, correct? You've used up some of that asset. You have some left. How much asset do you have left? 1,000. So here is the journal entry that we make. This is actually the adjusting journal entry that we make. And I'll abbreviate that AJE. we are going to decrease our prepaid insurance. How much did you say was used up? And what do you think gets debited? Insurance expense. That did two things. That decreased our prepaid insurance to its correct amount, and I will show you that by, let's do this. Okay, in our original entry on 12/30, we debited it for $1,200. Now we're at the end of January. What'd you say that asset was worth at the end of January? $1,000. So we need to credit that, and that's what we do down here, to make that asset now worth $1,000. So what is the AJE? What is the adjusting journal entry? And we made this on 1/31. What is the AJE that we will make on 2/28 of 010, the last day of February? The exact same journal entry, because we used up another $200, right? And this prepaid insurance will be credited again for $200, and now our asset shows at $800. So I think that goes towards answering some of those questions that you asked a few minutes ago, Brian, as far as how that would be recorded. Okay? Let's go back to the PowerPoints. Okay, they give you the same sort of example in your PowerPoints. I just don't like it. There's just too many numbers there. I think it's easy to get lost in all the 24 months worth or whatever. But they're basically saying the exact same thing that we did. I just did it in a little bit simpler way. But this is another example you can look at if you want. Now, this process recognizes that we are under the accrual basis. The accrual basis, two of the most important accounting principles are the revenue recognition principle, which once again states that we recognize revenue when it is earned. When is it earned? When we've provided the product or the service. And it also follows a new principle called the matching principle. Now, I think they actually had the matching principle in that chapter that we were talking about the principles. And I think I kind of said, let's talk about that one a little later. Remember that? This is a little later, okay? So it does talk about the matching principle a little bit in chapter 1, but now is where I really wanted to address it. What is the matching principle? Now, there's not a real good definition up on the screen to say what is the matching principle, so let me just tell you this, and you might want to write this down. The matching principle states that we want to, let's see what's the best way to word this. We want to recognize expenses in the periods in which they helped create revenue. We want to recognize expenses in the periods in which they helped create revenue. Now, that delivery vehicle that we talked about a few minutes ago, that insurance expense, that helped us provide and earn revenue for those 6 months because we were able to use that car in our business, right? We have effectively thus matched $200 to each one of those 6 months in which that automobile helped us create revenue. So that is the matching principle. So the AJEs that we learn in this chapter are going to be following these two principles, okay? Now you might say, okay, Krug, you use this term adjusting journal entry. What is an adjusting journal entry? Well, I'm glad you asked. Okay, first of all, it's a journal entry. An adjusting journal entry is a type of journal entry. It's going to follow all the rules of journal entries. The total debits have to equal the total credits. The accounts being debited are listed first, and then the accounts being credited. It's listed with all the other journal entries. It's just a little bit of a special type of journal entry. It is recorded to do two things. It's going to bring an asset or liability account balance to its proper amount, and it's going to recognize a revenue or an expense. Now, if you look back at the AJE that we did, there it is right there. If you look back at that adjusting journal entry, this accomplished those two purposes. It credited prepaid insurance to bring that asset to its proper balance, and it also booked $200 worth of insurance expense into January of 2010, didn't it? So that AJE followed those two guidelines. Okay? Two more things about AJEs. Adjusting journal entries are made on the last day of the period. Now, AJEs are largely done in that period of time where we say we are closing the books. Have you ever talked to somebody and you say, hey, how's work? And go, oh, it's horrible busy right now. We're closing the books out. Okay? Now, some companies only close the books once at the end of the year. Other companies close them out each month. Okay? Thus, some companies make AJEs only at the end of the year, while other companies make AJEs at the end of each month. That's why I said, going back to the PowerPoint, AJEs are made on the last day of the period. I didn't say month or year or whatever, because it depends on how often they close their books, which ultimately depends on how often they're going to want to put out financial statements. Okay? AJEs are made on the last day of the period, and the cash account is never, never, never part of an AJE. Now think about those two rules. They're made on the last day of the period. The cash account is never part of an AJE. Let's go back to that AJE that we made. Well, sure enough, it was made on the last day of the period, right? And is cash one of those accounts being debited or credited? No. Now you might say, well, Dave, cash was a journal entry up here. This is not an AJE. This one right here, this guy is not an AJE. This is the AJE. Okay? And if you have cash being debited or credited in your AJE, then you made a mistake. Okay? All right. There's also, let me see when the best time to say that. Let's do it now. Let me give you a little hint. This is a Dave Krug hint, invented when I was at Kansas State as a student. It's now used worldwide, but it's not discussed in your book. Not yet anyways, okay? Here's a little rule of thumb that I developed when I was learning AJEs, okay? And I'm going to pass it on to you. I want you to spell out the word real. Like this class is real fun, okay? This class is real fun. Spell that out. Now what I want you to do is draw a line down the middle of the word. You with me? Okay, this isn't in your book, so you want to write this down. What do you think these letters stand for? I'll give you the first one, and I bet you can get the rest of them. Revenues? Equity. Nope. Expenses, but close. Revenues, expenses. It's not as easy to write going down as you might think. Okay? That's what those that's what those four letters stand for. Okay, now listen to me. Every time you make an AJE, it will affect one of the ones on the left side and one of the ones on the right side. Every time, every time, every time, every time. For instance, when we made our AJE earlier, it affected an expense, and prepaid insurance is what? An asset. So one from this side, one from this side. So you'll never have an AJE where there is a revenue and an expense in it. Or you'll never have one where there's two liabilities or two assets. Okay? Or an asset and a liability. No, 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 no. It'll always have one of these guys and one of these guys. Now, why do I say that? Well, because sometimes you can reason through half of the AJE. Going back to our insurance example. Let's say I'm like, well, I know I have to decrease prepaid insurance by 200. I know that because I have to decrease the asset. But I don't know the rest of the journal entry. Well, you've just addressed an asset, right? You've just made an entry to an asset. So your only choices are you either debit a revenue here or you debit an expense. You see what I'm saying? That's your only choices. And then you might go, oh, it's definitely debiting an expense. Okay? You with me? So that's a little learning tool for you. Okay? Let's go back to the PowerPoint. Now there are 5 types of adjusting journal entries, or AJEs. There are 5 types of AJEs. There are those involving prepaid assets or expenses, and that's the type we actually just did with that car insurance example. There is an AJE in regards to depreciation. You've probably heard that term before. There is an AJE in regards to unearned revenue. And what type of account is unearned revenue? It's a liability. There is an AJE in regards to what we will talk about as an accrued expense. And lastly, the 5th category of AJEs are those having to do with accrued revenues. Are you with me? Okay? All right. So what we're going to do, and I don't know that we'll get through all 5 categories today. I'm going to bet we will not. But we're going to talk through each one of those 5 categories of AJEs. Now listen to me on this, okay? Listen to me on this. The way to learn AJEs is to do them. To do them, to do them, to do them, okay? You just have to do a lot of different AJEs. Now there's only 5 types of categories. So you'll start to recognize, okay, this is this type. Okay, that's okay. You'll get adept at it. But the way to learn this AJEs is not to just watch Krug do them, okay? The way to do them is to train your brain to think through them and to look at a blank piece of paper and be able to produce the AJE. You with me? Okay? For you folks at home, same thing. You folks at home have an extra discipline factor involved because I don't ever collect homework. I don't see if you do it or not. You're at home doing whatever, okay? But you have to be somewhat disciplined on an online or television course. Because I'm not collecting homework, but that's the way that you learn this stuff, isn't it? By doing it, okay? So, let's talk through these categories, okay? All right, first type is very, very similar to what we did. Here is just another example, and actually it's very similar because it's prepaid insurance and it's for 6 months. But on December 1 of 2007, Scott Company paid $12,000 for insurance for December of 2007 through May of 2008. Scott recorded the expenditure as prepaid insurance on December 1st. Okay, so on December 1st, what Scott Company did is they debited prepaid insurance, the asset, for $12,000, and they credited cash for $12,000. That's not the AJE, but that's the journal entry that they made when they got this asset. What AJE is required at the end of the period? Well, how much of that insurance have they used up? Well, they've used up $2,000 of it, correct? So this AJE decreases an asset by $2,000, and it books $2,000 of expense into December of 31. Now this situation is a little bit different because they bought it on December 1st, and the coverage actually began December 1st. Ours, I think, began January 1st, did it not? So that's why this AJE is dated December 31 as opposed to January 31. Okay? Questions on that one? Okay, another example. And you can see the T accounts. And the prepaid assurance at the end of December is properly at a balance of $10,000. Now, this is in the same category, but this is another example. During 07, Scott Company purchased $15,500 of supplies. Scott recorded the expenditures as supplies. And supplies is what? What type of account? Asset. On December 31, account of the supplies indicated $26.55 on hand. Okay. All right, let's step away from this a second and go back to the camera. Okay? Let me try to put this in a situation that is more identifiable. Okay? Peter, how old are you? 21. Okay, I can use this example on you. Okay? Let's say at the beginning of the day, you went to the grocery store and you bought 12 beers for your refrigerator. And you put 12 beers in your refrigerator. Correct? Okay? You go to school, you go to work, you come home at the end of the day, you open up the refrigerator, and there's 3 beers left. Somebody drank 9 beers. Is that correct? You started with 12 beers in your fridge. At the end of the day, there were only 3 beers left. Somebody drank 9 of those beers, correct? Or maybe, hopefully it wasn't just one person. Hopefully it was a variety. And you're 21, so I can use this example. Of course, if you're 20 or below, you can't drink beer, correct? Okay? So that's why I made sure you're 21. Does this make sense? You put 12 beers in your fridge. At the end of the day, there's 3 there. Well, some people came over and they drank 9 of your beers. This is the same example. This is the same situation with this PowerPoint, going back to it. You purchased $15,500 of supplies. But at the end of the year, you count the supplies and there's only $26.55 on hand. Thus, how much of those supplies have been used up? Well, it's not a real easy number. It's not one I can figure out in my head anyway. Huh? Something like, yeah, $12.85. $12.85 of beer has been drunk, so to speak. $12.845 of supplies have been used. So what do? We credit supplies. We credit supplies. Supplies is a debit balance account. It's an asset. Thus, when we credit, we decrease it. And what do we book the debit to? Supplies expense. Are you with me? Supplies expense. Does this follow that REAL rule, looking back at the journal entry? Go back to the PowerPoint. Does this follow the REAL? Yes, because supplies is an asset and supplies expense is an expense. Correct? Does this make sense? So, okay, questions? Now, before you get too worried, I know we're just on the first of 5 categories of AJEs. The first category takes the longest, okay? The last 4 categories will go a lot quicker, so don't worry too much, okay? All right. Any questions on this? Okay, I think we're going to get to at least the second category, and that is for depreciation. We'll do the second category and we'll call it a day. But I need to talk about a few things with depreciation. Okay, what does the screen say? Depreciation is the process of computing expense from allocating the cost of plant and equipment over their expected useful lives. Okay, Now put a star by that definition, not because I'm going to ask you to write out that definition on a test, but because I need to emphasize something very, very important. Let's cut back to me if we can. Where have you heard the words depreciation before?
House.
In regards to a house or car, a lot of times with a car. Because sometimes you'll hear things like, well, Zach bought a $15,000 car, brand new car. As soon as he drove it off the lot, it's a used car. It's already down to $10,000. You ever heard stuff like that? This is very important what I'm about to tell you. Depreciation in the real world can mean different things. And sometimes it has to do with what market value of an asset is. Okay, now this is very important. In accounting, depreciation is taken on fixed assets. It is not taken to try to reflect the market value of the asset on the books. That is not the purpose. We do not depreciate assets, or we do not make AJEs for depreciation to try to reflect the decrease in market value that may or may not have occurred on an asset. That is not why we do depreciation in accounting. Okay? The reason we do depreciation in accounting is because it is a better following of the matching principle. We want to simply spread the expense out to a number of different periods. Does this make sense? Example. Let's say that I pay $60,000 for a truck, big truck, that I'm going to use in my business. $60,000 for a truck. Well, it wouldn't make much sense to expense $60,000 in, let's say I bought it December 20th of 2009. To have a $60,000 big old stinking expense in December of 2009, I mean, that doesn't make much sense, does it? A better way to do it was to say, okay, now how long do I think that this truck is going to help me provide revenue? Oh, probably about 5 years. Wouldn't it be better to spread that expense over 5 years in small chunks? And if you do monthly financial statements, maybe even smaller chunks and a little bit of an expense each month to recognize. Isn't that a better following of the matching principle? Do you see what I'm saying? And that's what the purpose of depreciation in accounting is, to spread the expense out to a number of different periods. It is not done to try to record assets down to what the market value is. Because let's face it, I can take a used truck, and Brett, what you think it's worth is probably different than what Peter thinks it's worth, which is different than what Keeper thinks it's worth, which is different than what I think it's worth. Okay? We do not prepare a balance sheet, for the most part, on trying to match market values. Okay? Does that make sense? Very important. So going back to the slide, depreciation is the process of computing expense from allocating the cost of plant and equipment over their expected useful lives. So this is depreciation is kind of just a similar situation as supplies and as prepaid insurance, the first category, except it's in regards to fixed assets or property, plants, and equipment. Now, how do we compute how much to depreciate each period? Well, that formula is on your screen. Straight line depreciation equals your asset cost minus salvage value over useful life. And an example is going to help clarify this. What is salvage value? Salvage value, another term for salvage value is residual value. That is just what we think it might be worth at the end of its life. Okay? Let me give you an example. I think it'll help. On January 1 of 2007, Barton Inc. purchased equipment for $62,000 cash. The equipment has an estimated useful life of 5 years. We think it'll last us 5 years. And Barton expects to sell the equipment at the end of its life for $2,000 cash. Let's record depreciation expense for the year ended December 31, 07. Okay, they're just doing depreciation on a yearly basis. They're doing the AJEs on a yearly basis. How would we compute depreciation? Using the formula we just saw, we would take the cost of the asset, $62,000, minus the residual value or the salvage value of $2,000. And then we divide it by 5, which is the estimated useful life in years. Thus, what we get is $12,000 depreciation that we should take per year. Okay? We're going to book $12,000 worth of expense per year. Now, if we were doing monthly AJEs and monthly financial statements, how much would we depreciate per month? $1,000. Okay? So that is the amount that's going to be depreciated. Well, what does that journal entry look like? It looks like this. Let's talk about this. Whoops. We debit depreciation expense and we credit an account. You might think that we credit the account called equipment. We do not credit the account equipment. We credit an account called accumulated depreciation of the equipment. Now, whenever we introduce a new account, this is a little bell should go off in your brain as far as, oh, this is one I want to add to my flashcards. In other words, I need to know what type of account it is, whether it's a normal debit or credit balance account, and what financial statement it goes on. You with me? Going back to accumulated depreciation. What type of account is accumulated depreciation? Well, it is not an asset. It is actually what we call a contra asset. Contra asset. Now, have you ever heard the word contra before? Where have you heard the word contra?
Contradicting.
Contradict. I'm going to contradict you. Right? Right? I'm going to contradict you. Where else have you heard the word contra? Contraband. Isn't there a video game called Contra? Isn't there? There used to be? Oh, come on, you guys know. Okay. Contra, the word means on the other side of. So if I contradict you, you might say, I think the Chiefs are going to the Super Bowl this year. And I say, I'm going to contradict you. I think they are horrible. Okay? I am on the other side of. The video game Contra, you are fighting people who are on the other side of you. Correct? So the word contra means on the other side. Okay? Going back to the screen, an asset is a debit or a credit balance account. An asset is a debit balance account. So a contra asset is what?
Credit.
A credit balance account. Thank you. So this is the journal entry that we make. Another learning tool from Dave's past life as a student. This journal entry spells out the word dead. D-E-A-D. Okay? D-E-A-D. You with me? We debit depreciation expense. We credit accumulated depreciation. Now, how does accumulated depreciation look on the financial statements? This is very, very important. Okay? Here is a partial balance sheet. We list the equipment at $62,000, and when we make this depreciation entry, we do not decrease or credit equipment itself. Instead, we go to this account called accumulated depreciation. The way that this looks on the books, and this is a great test question, is you list the asset at 62 less the contra asset of 12,000, and that gives you a book value current at December 31 of 07 of $50,000. Okay? Now that's December 31 of 07. What about December 31 of 08? What's that going to look like? Well, it's going to say equipment 62, accumulated depreciation not 12,000, but what? 24,000, and the book value will be what? 38,000. Now you might ask, okay, Krug, I think I'm understanding this. I'm not sure though why we just don't credit the equipment itself instead of using this contra asset deal. I want you to think about that between now and the next period. Why might we use the accumulated depreciation? So that's what depreciation is. I will tell you one other thing too. Trucks, buildings, conveyor belts, forklifts, all those things are depreciated. There's one type of property, plant, and equipment that is not depreciated. We do not depreciate land. We do not depreciate land. Okay? So, let's go. Let me give you your homework and we shall call it a day, okay? I know today was a lot of lecture and you didn't get a chance to do anything in class, and I usually like to do that to keep you all awake. So, sorry about that. Next period won't be so much lecture. Okay? Okay, let's do I don't know if you can see that. Let's do quick study 3.4. And 3.5. And that's it. I'm only going to give you that as homework, but by golly, by gum, I want you to do those, okay? Don't come to class unprepared. Do those AJEs, and we will talk about the last three categories of adjusting journal entries next time. Next class period, I anticipate us working in class on some examples, so you might want to bring your calculators as well. See y'all.